Hello everyone, welcome to AQA the Learning Hub. So this is our last and final video of the stock playlist, and I hope you did like the entire playlist and you have already subscribed to our channel, the AQA the Learning Hub, for further details about various topics like mutual funds, and you have already visited our IPO playlist and other videos. Now, in this last and final video, we'll first be analyzing the bull and the bear market. Then we'll go for the mathematical analysis of stocks, a bit of it, total returns, price exchange ratio, and everything. Then we'll finally end this playlist on a note that you have covered stocks and you are now well educated about buying and selling stocks and about various gains you make from these stock investments. So, yeah, should we begin with today's topic? So, yeah. Let's start. Let me define a bull market condition for you. So, a bull market is a market condition that occurs when investors are really optimistic about the economy and they buy stocks. Because of the greater demand of stocks, the value of many stocks and the value of stock market as a whole increases. So, we saw stock indexes, right, in one of our previous videos. So, these stock indexes are on a huge rise. This is mostly after elections or after a new happy budget when people and investors like this. So the budget, obviously, so they are very optimistic about the market that okay, we'll make a lot of gains this time. Then they keep on buying stocks. They keep on buying stocks of various companies, various markets, various sectors. They are in an aim or in an expectation of a gain they are about to make. So they buy a lot of stocks. This is called a bull market situation. They in expectation of gains. Sometimes this is also created. It was actually mostly created on purpose by big sharks, but now it's less common and it's mostly an original condition when investors are excited about the market gains and they make a lot of investments by buying various stocks. Next is a bear market condition. So how a bear uses its nails and everything to pull you down. So bear market conditions is a pull down condition. It is a market conditions that occurs when investors are pessimistic about the economy and sell their stock. As a result, there's a decline in demand of value of individual stocks and the stock market as a whole decreases. So in this situation, what happens to the indexes? On a whole, they are coming down, somewhat coming down. Now, particular company gains are also coming down, their stock prices, graphs, the indexes as a whole are also coming down because people are pessimistic. They are like, oh no, the government is going, the military rule is coming up, or this another government which is gonna come up is not that good, the country won't make gains, the companies might go down, the companies might not get favorable policies, they might not prefer producing in a particular country. So this is called the bear market situation when people are pessimistic and they try to sell off their shares and nobody is there to buy these shares. Shares are there to be sold, they are with the brokers but nobody is buying them. So this is called the bear market conditions. Yes, again, this was created in earlier times by big sharks for their own interests, for their own gains, but now it's less common due to the online thing, due to the various securities put up by the government. This is less common right now. So now we'll do the numerical portion. Let me define current yield for you. It is one of the most common calculation investors use to track the value of their investment is the current yield. It is the annual dividend of an investment divided by percentage divided by current market value. So it is the annual dividend you gain divided by current market value, and the current yield is expressed as percentage. So it is a percentage of what? About the dividend value and the current market value of the stock, and it is taken out into by into 100 the percentage, and it is called the current yield. So here we are done with current yield. Next, let me go with the total returns. Total returns are a very simple thing. Your dividends plus the gains you have made due to increase in price of stock over the year, over the time, over the months, over the days, both are added, the dividend gains and the overtime increase in price of stock, and yes, you get your total returns. So do you want me to repeat the formula of current yield? If you want me to, just put it in the comment section. I'll repeat it for you, I'll re-explain it in detail for you. But I really think most of us don't want to analyze the financial market in this mathematical way. We just want the general analysis to know how to buy and sell stocks and everything, how to calculate it. But yet, if you want the details, I'll make more videos for you. Let me once again say the formula of current yield: annual dividend upon the current market value, and the percentage is taken out here itself. Next, we'll go on to earning per share. It is another form of gain you make from the stock. Earning per share is very simple. It's our corporation's next after tax earnings divided by number of outstanding shares of common stock. So sounds complicated, right? Yeah, that's why you don't have to go in the detail. So earning per share is whenever a corporation is gaining, people are gaining, what is the gain they made per share as compared to the starting price in the financial year of that particular share? One share, not the entire shares. And what is the end price? Next is the price earning ratio, called the PE ratio. It is the price of one share of stock divided by corporation's earnings per stock over last 12 months. The measurement is commonly used to compare the corporate earnings to the market price of the corporation's stock. I'll repeat the definition for you. It's very easy. It might sound complicated, but yeah, it's easy. Price earning ratio is the price of one share of the stock divided by corporation's earning per share. So we did earnings per share, right? So we divide the stock's current value by earnings per share over last 12 months. Now we get this price earnings ratio. I'll say the formula again if you want. Earning per share formula is net earnings upon the common stock outstanding value, which is equal to your earning per share. You want me to repeat? It's very simple. Earning per share and common stocks outstanding value. The outstanding common stocks, you get your you get your earning per share. Now next is your price earning ratio. It's also very easy. It's market price per stock or per share. Market price at that particular moment, and divided by earning per share of the corporation, you get your price earning ratio. Market price per share and earning per share is equal to your price earning ratio, which is analyzed by the corporations to analyze their gains and how to represent themselves in graph to their stockholders, how to advertise for themselves, how to attract more and more investors. All these ratios are mostly used by them. You don't have to calculate them. What are important for you is total returns, dividend return, current returns, and that I have explained in detail to you. Still, if you want more details about these, do put it in the comment section. I'll explain it to you later. Now there are secondary market, primary markets, which we have already done in the IPO video. We may attach the link of the IPO video here and you can check it out in the IPO video. Investment strategies can be long term, they can be short term, they can be a buy and hold technique, they can be average technique. I have already explained it to you. After you gain a margin, you sell it off. In buy and hold technique, for short term gains, you will gain 20 rupees, 30 rupees per share. That too if you sit all day and sell it when the stock is at highest price in the market. When is it at the highest price? You get it after analyzing the market for a few days. And it's an easy thing. You can learn it by analyzing the market for a few days regularly. So I hope you did like our video. Do like this video and subscribe to our channel, the AccuWeather Learning Hub, for further videos, and then stay connected for the next upcoming playlist about mutual funds. Thank you.